Well, hello and welcome to the Benjamin Z. Miller Investor Networking Group. We have an exciting presentation today that I'm going to share where we're going to talk about the topic of bonds. We're going to go through the history of bonds and we're going to go into how that can fit within a portfolio. So a question that I am sometimes asked by investors is, well, why should I have bonds? You know, the government's printing a lot of money. Why would I want to have bonds if there's inflation? Well, good question. You know, the answer to that is that every government, ever since the history of the dawn of civilization, has been printing money. So inflation, there's always something going on the inflation side. But the important thing is to have some bonds and some stocks. And a good way to do that is rather than talking about my opinion, I'm going to talk about Harry Markowitz, who won the 1990 Nobel Prize for economics for some of the work that he did with modern portfolio theory. And if any of you have accounts at BlackRock or Merrill Lynch or Bank of America, a lot of what they do is actually has its roots in modern portfolio theory that's developed by Harry Markowitz. But when it came to, it's a very complicated theory and it has a lot of math in it. But ultimately, when it came to his own portfolio, Markowitz himself did a far simpler thing where he would put half of his money in stocks and he'd put half of his money in bonds. And then once a year, he would adjust his portfolio. So if the stocks went up a great deal in value, he would sell stocks and then he would buy more bonds, or vice versa. If the stocks dropped in value, he would sell bonds to raise cash, and then he would buy stocks at the lower prices. So it's hard to guess what's going to happen in the future. And that way you have all of everything covered. So basically the history of bonds, it's an interesting thing. It's originally the first bonds were issued by the Bank of England in the year 1694. They were issued to finance the war with Napoleon. And this here is one of my favorite images. It's actually Napoleon's horse, and you can see the mark there, Vizier, his horse. So it's been preserved. He's been preserved by taxidermy, but very interesting. So the types of bonds that were issued at that time were console bonds. Console bonds are bonds that are very long term, and theoretically they don't have an expiration date. A normal bond that you buy today might be 10-year bond or a 30-year bond or a 20-year bond, but console bonds supposedly forever into the future, in perpetuity, they pay interest. So they're not too common these days, but they definitely were used back then. Another interesting thing is before they had all of the laws on insider trading, Rothschild, who was around at that time when Napoleon lost at the Battle of Waterloo, it took time for news to travel on who won. So people didn't know if England had won or if France had won. And because the gilts were issued at that time, if there was a loss where England had lost, this could be devastating to the price of gilts. But in fact, England had won. So Rothschild, he got advance news. He had ahead of time news on who had won and who had lost, and he knew that that England had lost. That England had won. So when he knew that England had won, he went and announced that, hey, England lost, I'm going to sell my bonds. And when people were watching him and they saw, well, if he's selling his gilts, I should sell my gilts too, because England must have lost. So it caused the price of gilts to decline in value. It caused the price of gilts to collapse. And when this happened later, his friends and him, they went and bought the gilts up at very cheap prices and made a tremendous profit. Of course, that's considered insider trading today, but that law didn't exist back then. So what's the relationship between the interest rate and the prices? Well, it's fairly simple. As the interest rate rises, the bond prices fall, and vice versa. As the interest rates fall, the bond prices rise. So that is due to the fact that there's an opportunity cost to hold bonds. And that's something that's important to understand, that fundamental relationship. So here are some other factors. Let's say that a country, let's say we're talking about a country and there's economic growth. Economic growth might cause the bond prices to fall. Economic recession could cause bond prices to rise. Of course, central bank action will have an effect of causing the bond prices to rise or fall. These things are all relevant, but the first one is to know that if the interest rates rise, the bond prices are going to fall. So how are bonds rated? Well, they range. There's unrated small companies all the way up to maybe a large company that is AAA rated. Let's say the rating agency gave AAA. The rating agency might be the S&P 500. The default rate on that would be 0.52%, or 1 out of 192 times that company would default. Whereas if you go to, say, Moody's rating agency and something is rated A, in that case, it would have a default rate of 0.12%, or 1 out of 833 times you'd see a default. And of course, if you're talking about smaller companies, they have a far higher default rate. Why do people buy bonds? Well, they're looking for the income. They're looking for income. They're a predictable income stream. That's the main reason. What type of bonds are there? Well, they can be categorized by corporate government bonds. Those would be two main categories. And then there's also another type of bond that's called, in Islamic finance, they have a sukuk bond, which was, it's considered an alternative to bonds, which there's a prohibition on interest. And so they have a sukuk security. It's designed to comply with Sharia law by paying a profit, not interest. So it's a little bit of a difference there, but they're called sukuk bonds. But what are some of the key terms? Well, you'll hear the term notes sometimes. Note usually is if you're talking about a term that's less than 5 years. A bond is generally more than 5 years, and the term might range 5 to 30 years. You could have some bonds that are up to 100 years. You could have also console bonds, which don't even have a term where they're supposed to be paid off. Premium and par, that's just, we'll go through that on the next slide. And then the yield is just how much interest you get based on the price that the bond sold at. So we'll talk also about duration. Duration is very important because this is something that people that are inexperienced, they think, well, bonds are safe. I'm going to buy bonds, and then they'll go buy maybe a 30-year bond, a 30-year government bond, thinking, well, that's super safe. It's the government. But then the interest rate moves. Maybe the interest rate moves 1%. Let's imagine that someone bought a 30-year bond for $100,000 and the interest rate moved 1% on a government bond. That could have a massive decrease in the value of that bond if the interest rate increased, where if it was originally purchased for $100,000 and let's say the interest rate moved 1%, if it was a 30-year term, just say that as an example, or say it's a 20-year term. If it's a 20-year term and the interest rate moves 1%, the value of that bond is going to decrease 20%, assuming that the interest rate increased. And it would work in reverse if the interest rate decreased, where the bond could actually go up in value 20%. But this is something that if you don't understand it, the duration has a massive impact on the value of on the resale value of the bond. So that's something that you definitely need to know about. If you're talking about a shorter term, like a 2-year bond, say you bought a 2-year bond for $100,000 that was some sort of a government bond, and the duration on that was 2% with a 1% move, the price is only going to change $2,000. So it's definitely less volatile. So if you want to reduce the volatility, you want to you want to go with shorter term. Or if you want to reduce volatility completely, you can go with private bonds. Privately non-rated bonds don't have any volatility. The duration is something that can be calculated. You can do it on a financial calculator. I'm not going to go through the actual calculation here, but it's just a mathematical calculation where you take the years and the interest and the principal payment, and you can calculate the duration. Now, one mistake that a lot of investors make is they become obsessed with rating agencies, where they think that the rating agency can do all of their thinking for them. And that's a very dangerous position to be in. And I would like to remind everyone about Enron, the energy company Enron. Actually, Enron went bankrupt. It was a huge corporate bankruptcy. But the rating agencies, these same agencies that everybody's still in love with, that they all have to look at what the rating agency said, were rating Enron's debt investment grade. They were doing that on November 28th of 2001, whereas on December 2nd, just a few days later, Enron declared bankruptcy. Now, if that doesn't tell you or teach you that you shouldn't just blindly be a sheep and listen to a rating agency, there's no other example. Now, I'm not saying that the people that bought Enron were sheep. I mean, there's a lot of stuff that was going on there that wasn't real good stuff. But my point is, you need to do your own thinking instead of just assuming that the rating agency's got it covered and the rating agency can't make a mistake. And that is something that you want to look for, companies that are backed by hard assets. For example, my company, Alamo Mortgage Holdings, we have bonds that are backed by hard collateral, real estate, or Andesite Blue, another one of my companies. Our bonds are actually backed by hard assets. So that's a totally different thing than a lot of the corporate debt that's out there that is floating around. So par value, let's say you buy a bond at 1,000, it's quoted at 100. That would be, it's trading at par. Now imagine that the interest rates decrease. Say the interest rates decrease. I'm just giving an example here. The face value is still 1,000. Now, because the interest rates decreased, it would be quoted at 102, and it is trading at a premium to par. Now say that the interest rates increase. If the interest rates increase, maybe it had a face value of 1,000, interest rate increased. Now it might be quoted at 97, and that's trading at a discount to par. So that's how that works. It's important to understand those terms. Another thing that's very important is to understand how the exchange rate impacts the return, because a lot of investors, they think, well, you know, I'm in the UK and I can get 8% in the UK. Well, that is great that you can get 8% in the UK, but how has the British pound sterling been doing against the US dollar? Maybe that's something you should consider, and not consider it in terms of what happened last year. Consider the general trend. Let's look here at this chart, and it shows the general trend ever since the end of World War II, when the Bretton Woods Agreement was implemented. We see that at that time in 1945, 1 British pound would buy 4 American dollars. And now look at how much the pound has lost. The pound has lost to the dollar, dropped to $2.80 for a pound. Then a pound would only buy $2.40. Then a pound would only buy $1.59. And as of the 1st of January 2023, a pound would only buy $1.20. They're practically at parity. Now, this is something that's relevant, because if you're getting 8% denominated in US dollars versus 8% denominated in pound sterling, that can make a huge difference, because it's not the same. You've got different currencies there, and you need to know what's going on with the two currencies, because that will determine the real buying power in the market. What can you actually get once you try to buy something? So that's an important thing to keep in mind. And for that reason, let's say you're a UK investor and you are concerned about the pound losing even more value, which would be a relevant concern based on this long-term history. Well, in that case, you might want to consider converting out of pound sterling into US dollar based on this history. And if you want to do that, you should get in touch with me. You should send me an email, ben.miller@alamomortgageholdings.co.uk. And I can tell you about our program that we have, where we purchase US mortgage debt. We buy packages of mortgages, but we sell a bond in the United Kingdom that's denominated in British pound sterling, but we give people the option, if they would rather have it denominated in US dollars, we'll pay them the same. So let's look at how things also can affect. We have here war. War is an example. We're looking at the Ukraine USD bond price back in 2022. February 24th of 2022, Russia invaded. The evil war began, where all of these innocent people were killed for no reason. This was February 24th of 2022. And you can see right here, all of a sudden back here, it was trading at around par. Now all of a sudden it's trading at a steep discount to par. It went from around 100 to as low at some point below 20. That's devastating if someone had those bonds. Just absolutely devastating. And I know some people that had those bonds. Actually, I had talked to them about actually a couple of things before all of this happened. But it's a shame that happened. I feel for them. So what about the yield? We can see here, we look at the yield. Notice that on February 24th, 2022, the yield goes up. The yield is going up because of the fact that the value, the value of it's going down in the market. There's less demand for it. So the yield is actually increasing because the price of it has decreased. So the price of the bond decreases, the yield increases. Here we look at the Russian government bond yield. This was a dollar bond, but it was a Russian government bond denominated in dollars. And we see that before the war, the yield was right around, it was like 3-4%. Then all of a sudden, when the war starts on February 24th, the yield jumps through the roof. The yield goes all the way almost up to 20%. And that is because people are saying, I don't want these bonds. They are selling these bonds. They're saying, get me the hell out of these Russian government bonds. I want to get into something that's safe. And that's what makes the yield go up. So capital controls, they implemented another number of capital controls to try to stop all of this. But you can see here that it had a big impact on Russia. It had a big impact on Ukraine. We look at a corporate bond here of a company, Lukoil. Lukoil's a Russian company, and you can see here how much of an impact it had, where it invades and the bond, that corporate bond, just collapsed. Where it was originally, it was trading at a little bit of a premium to par, then the invasion, and it goes to a massive discount to par, where it's just going like crazy. So, but where is all this money going? This is actually an interesting situation here. We've got a chart that shows, this is also the 24th of February, 2022, the day of the invasion. We see here, we're looking at a 10-year treasury yield. And if you look at this, not the blue line, but you look at this line, you see how that 10-year treasury yield, it's basically increasing. So the yield is shown over here on the right. So the yield is increasing. What that means is that the 10-year treasury yield was increasing. So that means that the price of it was actually decreasing at that time. Now, as soon as the invasion happens, all of a sudden, people start buying US 10-year bonds. And they are doing that because they are selling, for example, Russian government bonds. They're selling Ukrainian bonds. There's money from all over the world that is creating a demand for a safer asset, because the US is not involved in a war and it's viewed as safer. So you will see that the yield actually flips here, where it goes from a positive yield where the yield is going up to now the yield reverses and the yield starts coming down. And when the yield reverses and the yield goes lower, that means that the price of the bond is going higher. So definitely something that's relevant. So a lot of that money actually made it over this way. This is something where a lot of factors come into play. There's foreign reserves, very important in terms of how does that all play out with foreign reserves. But as of August 2023, the government bond prices in Ukraine, they have climbed 50%. Things are starting to really stabilize a bit more in Ukraine. So another thing that you will often hear is yield curves. So you'll have a positive yield curve, you'll have a flat yield curve, and you'll also have an inverted yield curve. You can read more about this, but essentially an inverted yield curve, it is a predictor that a recession is likely. So that is something that's relevant. So why would you buy bonds if inflation is rising? Well, you need to have in your portfolio some bonds, some stocks. You need to seriously consider that, because we're going back here to 1987 in the United States, Black Monday, and I remember it well. Basically, on that day, there was a huge collapse in the Dow in the stock market, where all of a sudden the stocks collapsed, and we see here Black Monday, the price of stocks just went from, this is the Dow Jones Industrial Average, it was around 2,500, and it falls all the way down to 1,800, 1,900, a massive drop. Well, if you had all of your money in that index, if you had 100% in stocks, you cannot sell bonds and buy more stocks because you already put 100% of your money in equity. So that's why that's important. It's just a couple of reminders, the sign-in sheet, we've got that. Please fill out the sign-in sheet. And if you're watching this on the internet, if you have any friends or colleagues, if you want to come to this, just send me an email, ben@benjaminzmiller.com. I also want to let you know, if you're interested in learning about investing and you would prefer the easy way instead of the hard way, if you would prefer to have somebody that knows something educate you instead of learning in the school of hard knocks over many years, I am available. And just text me or call me or email me. I hope that helps, and I wish you good luck with your investing. We have these meetings every week, and just email me if you'd like an invitation. All right, that is it. So I'm going to go ahead and stop the presentation, and I wish everyone a fantastic day.